In the wake of the 2008 housing collapse, trillions of dollars in American household net worth evaporated. Nearly 9 million people lost their jobs as the housing market plummeted and global credit markets froze. Despite widespread evidence of predatory lending, falsified liquidity, and the mass distribution of toxic assets, a strange reality set in. The elite Wall Street executives who directed the collapse faced no criminal prosecution. This chart visualizes the law enforcement response to the savings and loan crisis of the 1980s. When those institutions lost an estimated $160 million, the federal government deployed specialized strike forces that secured over 600 criminal convictions against senior banking executives. This same chart looks very different for 2008. The institutional losses reached $1.2 trillion, thousands of times the scale of the S&L crisis. Yet the number of major Wall Street CEOs convicted of a crime dropped to zero. This disparity indicates that by 2008, the federal approach to corporate accountability had undergone a significant transformation, moving away from individual criminal liability toward a model that prioritized market stabilization. Part of the reason prosecutors struggled was that much of the reckless behavior had been systematically legalized. Late 90s deregulation, specifically the repeal of the Glass-Steagall Act, dismantled the firewall between commercial and investment banking, allowing firms to leverage toxic assets on a scale that was previously prohibited. When conduct did cross the line into potential fraud, investigators hit a massive statutory wall, proving scienter. To secure a white-collar criminal conviction, prosecutors must prove beyond a reasonable doubt that an executive had the specific, deliberate intent to deceive. Megabanks shielded themselves from this requirement through a highly compartmentalized structure known as the Murder on the Orient Express defense. A toxic mortgage product was originated by a broker, packaged by a structuring desk, and mathematically modeled by isolated analysts. Because liability was fragmented across so many global departments, individual culpability was nearly impossible to isolate. The lone exception proves the rule. The only Wall Street executive to serve federal prison time for the crash was Kareem Saragaldin, a mid-level trader at Credit Suisse. His prosecution only succeeded because investigators obtained internal recordings where he explicitly directed subordinates to manually override automated pricing systems to hide losses. Without that kind of explicit self-incrimination, the complexity of modern banking architecture acted as a legal fortress, rendering the financial engineering at the very top effectively unprosecutable. But the government wasn't entirely flying blind. Congress established the Financial Crisis Inquiry Commission to investigate the origins of the collapse and identify those responsible. Led by Phil Angelides, the commission conducted hundreds of sworn interviews and reviewed millions of pages of internal corporate documents to build a definitive record of the crisis. In addition to its public report, the commission forwarded 11 formal criminal referrals to the Department of Justice. These files named 9 high-ranking executives and 14 corporations where investigators found serious evidence of securities violations. Yet none of these specific referrals resulted in a conviction. Take Angelo Mozilo, the CEO of Countrywide Financial. Internal records showed his company bypassed its own underwriting guidelines to push highly profitable, toxic subprime loans. Despite internal warnings that this was a dangerous game, Mozilo settled civil charges out of court and never faced a criminal trial. The DOJ's failure to act on these exhaustive referrals points to an institutional paralysis. The department had been provided with a documented path to accountability and chose not to follow it. This reluctance was exacerbated by a massive resource mismatch. The DOJ was heavily outgunned by Wall Street's legal budgets, a dynamic worsened by the revolving door, where elite prosecutors frequently left the government to join the exact corporate defense firms representing the megabanks. But the choice to avoid trials was also formal policy. Under Attorney General Eric Holder, the DOJ adopted the too big to jail doctrine, which warned that prosecuting megabanks could trigger market panic and destabilize the global economy. The ultimate consequence of this policy was seen in 2012, when investigations revealed that HSBC had systematically laundered nearly $900 million for transnational drug cartels. DOJ leadership overruled recommendations to prosecute. To avoid a market shock, the bank was allowed to pay a fine. At the same time, federal agents with the Special Inspector General for TARP were successfully jailing dozens of executives, but these offenders were almost exclusively from small regional community banks, not the titans of Wall Street. The justice system had effectively created a two-tiered reality. For the largest institutions, individual criminal indictments were traded for massive civil settlements, allowing them to pay their way out of the criminal justice system using shareholder capital. The American argument was that prosecuting global bankers would be economically suicidal, but Iceland decisively proved otherwise, even after a domestic banking collapse equal to 11 times its national GDP. Forced to nationalize its failing banks, the Icelandic public loudly demanded accountability. The government established a special prosecutor specifically mandated to investigate the economic crimes that caused the crash. Iceland used standard fraud and market manipulation laws to dismantle corporate veils. Ultimately, they secured prison sentences for 25 top banking executives, including the CEOs and chairmen of their major banks. In the United States, the refusal to apply those same statutes against top-tier executives created a very different legacy. By relying on monetary settlements and deferred prosecutions, the justice system effectively moved elite financial fraud into a civil category. This failure institutionalized a profound moral hazard, signaling that massive fraud is simply an operational cost of doing business. But more enduring is the damage to the perception of justice, a demonstration that when institutions reach a certain scale, the law treats their leaders as distinct from the citizens those institutions serve.